Hello everybody. At this time we are talking about an investment property. Investment properties are real estate assets bound to generate returns either through rental income, future resale, or both. Held by individual investors, groups, or corporations, these properties can be either long term ventures or short term flips where investors renovate and quickly sell for profit. While often associated with real estate, investment property can also refer to assets like art, securities, or collectibles purchased for future appreciation. And then key types of property investments. The first type, residential properties. This is the most common type. Residential properties include single family homes, and then apartments, condominiums, and townhouses. Investors usually buy these properties with the intention of renting them out to tenants. The rental income, coupled with the property's appreciation over time, makes it an attractive investment. Second type, commercial properties. Commercial real estate involves properties such as office buildings, retail spaces, and shopping centers. These properties are typically leased to businesses. Commercial properties often yield higher returns than residential properties, but they come with more complexity in terms of management and longer lease terms. And then third, industrial properties. These are properties used for industrial purposes, such as factories, warehouses, and distribution centers. Industrial properties are usually long-term and can be less volatile due to the specialized nature of tenants. And then, what are the main types of property investment strategies? The first strategy, buy and hold. Buying and holding involves purchasing a property, preferably under market value, and renting it out long term to service and the mortgage and other holding costs. At the same time, the property investors will build equity over the years. Potentially, when the property has increased in value, the investors might sell the property for a profit. An investor who is buying and holding generally won't sell their properties very quickly because they're either waiting for capital growth or relying on the cash flow for day-to-day expenses. And then second, buy, flip, and sell. This is another popular property portfolio strategy for investors who want to make money from their properties without having to wait for capital growth. Buying and flipping typically involve substantial renovation work to manufacture equity. This strategy involves a property investors purchasing an undervalued but well-located property in need of renovation work and then selling it for a profit. And then third, buy, renovate, and hold. A property investor who is holding may also complete renovations to increase its rental and or market value. This is a popular investment strategy for investors who want to boost the returns from their property without having to wait for market growth. An investor will purchase a property, renovate it at some point, and rent it out at market rates. And then fourth, buy, subdivide, and sell. For investors who do not want to rely on values to increase, they may choose to do a subdivision. The investors will buy a large block of land and then subdivide it into two or more properties with separate titles. And then we move to common valuations methods for a rental property. The first, cash flow. Cash flow is the amount of money an investment generates each month through rent after considering the property's expenses. To determine cash flow, subtract the total operating costs and mortgage payment from the total rental income value. And then second, value per door. Value per door is the entire rental property's worth based on the number of units and the income each will generate. To solve, simply divide the sales price by the number of units in the building. Third, capitalization rate, also known as the cap rate. This is the rate of return that is expected to be generated on a real estate investment property. It is determined by dividing a property's net operating income by the current market value. And then fourth, sales comparison approach. A sales comparison for property analysis compares a property to comparables recently sold properties, otherwise known as comps, in the area with similar characteristics. This is not a formula, but more of a broad analysis that considers things like location, recently sold instincts, property features, property condition, and more. And then fifth, return on investment. Return on investment is the expected profit from a rental property as a percentage. To solve for return on investment, take the estimated annual rate of return, divide it by the property price, and then convert it into a percentage. And then we move to advantages of property investment. Some of the main advantages of property investments include the first, passive income. Property investments can generate passive income obtained without active involvement through leasing or sales proceeds. And then second, asset collateral. Owned properties can be used as collateral when additional loans are needed, providing greater financial flexibility. Third, value appreciation. Property values tend to increase over time, often exceeding inflation rates, promising long-term profits. And then fourth, easy management. Property investments does not require daily monitoring like stock or mutual fund investment. Simply purchase the property and manage it well to gain profits. And then fifth, protection against inflation. property price increases tend to be higher than inflation rates, providing protection against the depreciations of money. I think it is enough. Thanks for watching.